Why do Forex traders go short? One of the characteristics of trading spot Forex is the ability to take both long and short positions. But what exactly does this mean? Taking a long position or going long is trader talk for placing a buy trade. This is something you'd do if you thought the base currency of a pair was going to rise in value. Taking a short position or going short, on the other hand, means placing a sell trade. You'd do this if you thought the quote currency in a pair was going to rise in value. Unlike with stocks, you can sell currency pairs without ever having bought or borrowed them. This is because, with spot Forex, you're trading on the price movements of currencies, and there is no ownership of the underlying asset. So, why do Forex traders go short? Going short allows you to remain active in the market, even if it's trending downwards. This means you can trade both rising and falling markets. Another reason a trader might short Forex pairs is to hedge their positions. Hedging is a strategy that traders use to manage their risk. Say, for example, you already have long positions open on a basket of European stocks. If you also had a US dollar Forex account, you may want to hedge your currency exposure by shorting Euro-US dollar. This would reduce the currency risk created by your exposure to an asset denominated in a foreign currency. For instance, let's say the euro was to fall in value, negatively impacting your stock trades. Generally, the losses incurred due to your currency exposure could be offset by the profits from your Forex position. Of course, the opposite is also true. If the euro was to rise in value, this would add to the profitability of your stock trades, whereas your Forex position would likely make a loss. To learn more about Forex, visit trading.com.